Perfect.
Hello everyone, this is Flybur the Devil Stockbrokers Discord's basement code monkey. Okay, I do not have his voice. Anyway, so,
That was awesome.
I like it.
That was actually pretty good.
oh shit, he was here all along.
You know he's
He
here.
was.
Yeah, I had no idea. Anyway, uh, okay then, let's do this. So, this is gonna be like a super basic kind of fundamentals of fundamentals introduction to technical analysis. Um, if you're gonna be hearing me coughing, that's because I still have COVID, but whatever. Um, so we're gonna be starting with moving averages because I mean candles and moving averages they're kind of the basics to everything when it comes to trend spotting. Generally speaking, this is going to be mostly with my kind of bias. I don't do much charting or uh, I don't look for these patterns. So this is just kind of my take on things. I really believe in price key and price being key and indicators based on the price action itself. And the most basic kind of indicator would be various moving averages and the indicators that are built on top of those. And I'm probably going to be taking a bit of time to go over how the MACD works, which is an indicator that's super widely used, but many people don't really understand how it works other than trying to figure out its signals. So yeah, let's get into it. This is an open discussion, so feel free to ask questions at any point. Uh, So, can everyone see my screen, by the way? I don't think I checked other than Verde.
Uh-huh.
Yeah, okay. So I have AMC up here, and I'm gonna be using it for the most part because last week, uh, when I did a similar session, then it seemed like AMC had a bunch of interesting use cases to look into. Um, okay, so let's start with it. So when you're starting with looking at a chart, or rather when I'm looking at a chart and I'm looking for uh, trading signals, let's put it this way, then my personal strategy and general approach is to try and trade the trend. Uh, I don't feel as comfortable doing anything else as a retail trader, unless you have this monster squeeze play happening. But those are the outliers. In the day-to-day, I try and play the trend. So this is pretty much the general philosophy we're going to be looking at over here. Everything we're going to be talking about is to help you find the trend. So when you open up a chart, the first thing you're seeing is a bunch of candles, right? And just at a glance, you get all this information, and just to make sure we're all on the same page, or whether someone in the future watches this recording for some reason, these little bars are what I refer to when I say candles. They give you the open, close, and low and high of the price in that unit of time. So I'm on the daily right now, and we're gonna be. This is true for all the other time resolutions as well. And this on its own gives you a lot of information, but when you're trying to make swing trades or just trying to get this initial view of what's going on, it doesn't really tell you that much, but it can give you some. It can give you a gut feeling. But when we're trying to make trades, we're trying to trade with data. We don't want to use our guts that much. You could get a gut feeling for this kind of things, but especially since most of us are newbies and since these big players are trying to mess with us on a psychological level, then I try to be data driven in my approach. And the very first tool that I turn to when trying to find a trend to trade with is the moving average. Now on my chart, I'm still assuming people can see it, we have several moving averages, and the idea of a moving average, unlike just a normal average, is that it takes a subset of the data, or this moving window of data, when it tries to calculate the average. So let's say 5-day moving average would take the last 5 days worth of data and perform the average on those specific days, rather than the entire data set. So what we're seeing on my chart right now are several moving averages. I think TD mentioned this indicator because I like having them all together, but let's just focus on the top one here. So this blue line, this is a 200-day, or rather 200 period simple moving average. What do I mean by a simple moving average? So we broke down the moving average bit of the term, but what does simple mean? So there's a solid chance you heard about exponential moving averages, triple exponentials, all these kind of modified moving averages on top of the price
Whole
action.
bulling there.
What? Sorry?
The whole as well, the Bullinger and so forth.
Yeah,
Like there's
precisely. So the simple one is, well, it is the simplest, most basic one. It refers to nothing coming on top of the, let's say, the average function. It basically sums up let's assume we're looking at closing prices. It sums up the closing prices. And now let's look at the other parameter I said. I said this is a 200 simple moving average. So not all of these lines are created the same, and the length of a moving average affects the kind of picture it draws when we're trying to identify the trend. So even just the word trend doesn't exactly tell you which time frame you're looking at. Are you looking to play a super long-term trend, or are you looking to play a medium or short-term ones? This really depends on what you're trying to achieve, but the combination of several moving averages can help you grasp, or rather better grasp, what direction and what kind of risk you're taking on by entering a position. So the very first one I tend to look at when approaching a trade is the 200 simple moving average. Why 200? It can be any other number, but the general idea here is to take a long-term moving average, a medium one, and a short one. Now, somehow the numbers are typically 200, 50, and 20, but you can obviously change these according to what you want. So I'm going to be using 250 and 20. Although later on with the MACD we can see I'm using different settings, but we'll get there. So the 200, that is my long moving average. That is supposed to give me the general long-term trend of the security I'm looking at. So if I'm looking at AMC here, just by looking at it like this, I can tell that there was this very, very minor uptrend that is now turning back down. Now this is something I could have probably know just by looking at the candles, but you can see just how, for example, let's look at this movement from back here in June of 2021. You can tell how irregular this squeeze kind movement was here in relation to the trend itself. So we can very strongly say that over here we had this deviation from the long-term trend, and this is a very important point of interest we're going to be looking at in a moment. But from here on, you can say the long term, aside from taking this point aside, this is going into a downtrend in the long term. So this is the 200 one. The place where it gets interesting is when you're starting to compare the price action to the location of the moving average itself. A moving average, or you're actually going to see this is in relation to the other moving averages as well, but let's ignore those for the time being. A moving average being over the price action generally recommends weakness in price or momentum, and with the price action being over the moving average shows you strength. We like to call these up and down trends, really, but it's more than what meets the eye. Just being above a moving average doesn't necessarily tell you it's an uptrend. You also have to consider other things we're going to be talking about, but just being above it is a sign of strength, first and foremost, and that's the first thing I'm going to be noting to myself when I'm seeing the price. So now let's look at another moving average and see how it comes together with the price action and the long-term moving average. So you can see there's another line here, the blue one. There it is. You see it right here. It's sandwiched in between the price action and the 200 SMA. This is the 50 SMA. So you can see it going over here. There's this interesting cross, and let's ignore this bit for now. So the 50, this is going to be what I'm using to try and gauge the medium-term sentiment and strength of momentum. So what does this immediately tell me? So first thing I'm noting, it is over the price action. And what we just said, that this actually tells me that there is some kind of strength coming through. I mean, it's telling me there's a weakness coming through the price here because I'm underneath the average. But not only am I under the 50 moving average, I'm also under the 200 moving average. So in a sense, you can say that the more moving averages you're under, it tells you greater weakness in the price. So you can also see that there is another moving average in here. This is the 20. So once you're under all those moving averages, that is great weakness in the price action. But as you start breaking above these moving averages, this is what's going to be telling you or hinting at a change of momentum. So looking at AMC, let's zoom out a little and have a look at this period of time. Something very interesting happens here. So first thing we're going to be noticing, this is where AMC dropped under the 200 moving average. This is a pretty telltale sign that a downtrend is about to follow, and we can see that that pretty much played out. But if we look over here, the real moment when things really took a nosedive is here. The lighter blue line, which is the 200, which is the 50 moving average, crossed under the 200 moving average. Why is this a point of significance to us? So you might have heard about this being referred to as a death cross, while the reverse being referred to as a golden cross. This generally refers to a crossing of a faster and slower moving average in general. Now let's break this down and forget about the numbers themselves for a moment. Let's just think about the concept behind it. A faster, or rather shorter, moving average, so a 50 moving average in this case, is affected by a smaller data set. That means it's more receptive to changing prices. So when the trend starts changing, the shorter the moving average is, the faster it's going to react to it. So what can we take from this? So if the 200 moving average takes longer than the 50 moving average in this case to react to the change, the moment the shorter one falls under the long-term one, this is called a death cross because it signifies it's a very strong signal that the overall momentum has changed to the downward direction. And this is just what the price action is telling us, since a moving average is a function of the price itself. The moment you have enough closes heading downwards, once the moving averages themselves start crossing underneath one another, that's when you know, as a trader, taking a long position in this kind of scenario, you can probably benefit in a super lower level time resolution, But in this one, anyway, in the daily, this is a bad time to be taking a long position because you are going to be trading against the trend. Now let's move on a bit here. There we go. So over here we have something else happen. In this point in time, in March of 2022, the price action broke above the medium or 50 in this case moving average, but it was still underneath the long-term one. So what does this tell me as a trader? This tells me this is a point where we're probably going to be seeing some kind of trading in a channel. It doesn't tell me anything about the strength of the downwards trend. I'm still in downwards trend, but the moment this happens, this tells me that in the short term anyway, there is a change of direction. And indeed, this is what followed in the days afterwards. Let me zoom in a little so we can take a better look at this, because this is where I want to mention the even shorter moving average. So this super light blue line here, you can just barely see it. This is the 20 moving average. This is much shorter than the 51. So like we said, in general, when a shorter moving average crosses a slower one, this is a point of interest when it comes to gauging strength of momentum in that time frame. So as you can see here, the short-term moving average, the 20, is crossing in between the price and it is hugging it from both directions, but for most of the time it is over the price. The price is under the moving average here, here, here as well. In these few days where there was a slight uptrend, it was above the moving average, just like we said. But this is this is where things get interesting. On the 17th of March is where the price crossed the short-term average once again. This tells me that there is strength in these coming days, potentially. But the real interesting bit is when it then crossed the medium-term average as well. What then follows is this sort of golden cross, sort of, because the golden and death crosses are typically reserved when talking about 250, but you have a short-term moving average crossing above the medium one. And indeed, this was immediately followed by very, very strong move to the upside. And if I were a trader just following AMC live here, and I saw this starting to happen, then I would probably take a long position, knowing that it's going to be a short-term move somewhere around here when we crossed and maintained the position above the medium-term and short-term moving average. I'm not even talking about MACD, RSI, OBV, all that fun stuff. This is just purely most naive trading based on the technical of a moving average.
Can I ask a question, please?
Of course, sir. Of course.
Where would have you chose? How would have you chosen a stop loss in that case?
Okay, so this is a good question. So for those who don't know, I'm just assuming this might be viewed by complete newbies. So a stop loss is basically an order to sell at a price to stop a loss. Let's just put it that way. But then the question that is asked is, where do you want to exit the trade when it's going against you? So this brings us to sort of a concept I was alluding to without saying its name, but there is the concept of resistance and support in trading. I'm sure people have heard about it. Just like I said earlier, I don't believe in charting too much. That also means I don't believe in fib serving as a reliable support and resistance, but that's just me, whatever. But support and resistance refers to price points where you're expecting the price to either have to break to make a move, or if it falls under it, then it will make a significant downwards move. So when you're trying to put a stop loss, you're trying to select a price where you're hoping you'll be able to get out before the downwards move will come along. So if you're trading purely on moving averages, then the moving averages themselves can hint to you where your stop loss should be, because in a way they themselves represent lines of support and resistance, because not only do they show the psychological level people are looking at, because even if technically they don't mean anything on their own, enough people regard them as something of value, kind of like fib, that it kind of turns out to be true in the end. But the actual position of the moving average in this case uh, tells you what was the price that beyond it enough people got a confirmation that the move was strong enough. So to answer your original question, I would probably be taking a stop loss here along the long-term moving average, because I would only take this trade once it broke and held above it, and it would probably it could bounce off it once it made it into a support rather than a resistance to break. So I'd assume this is a support, and I would put a stop here at 18, probably something like that. So I'm not gonna go into how I would then choose to take profit, but just in terms of protecting myself, I would use the moving average as a support once I've maintained myself above it. Does that answer your question?
Yeah.
And do you accept the answer, or do you want to talk about it?
No, because it's I just wanted to just point out the exactly what you said. Moving averages, can be resistance and support, but then on top of that, you said you only referred to it as taking a long position, and not talked about like a stop loss, which I think in order to be profitable, you always have to be considering. I just wanted to make sure that you touch on the stop loss thing when using moving averages, basically.
Yeah, fantastic. Thank you for that. So
I did want to I did want to sorry, Glenn. I did want to bring up that topic because I know you said you didn't want to like decide on how you would take profit, but I feel like it's important to at least touch on it. If the way that I do take profit and stop losses is I have a very clear risk to reward ratio, and if you use the long tool with TradingView, plenty of other brokerage tools have this tool, but the long tool allows you to set your stop loss, and you can set a specific risk to reward ratio. When I'm doing trades such as what Flab is highlighting, I set my entry price based whatever my entry is, whatever I'm getting in at, I set my stop loss either whatever the stop loss is. If it's based on those moving averages, I might select a ratio of 2 to 1, so that if I'm wrong, I only lose like 1% of whatever position I set. Like if you're trading with the traditional 1% risk of your portfolio at a time. So if you hit your stop loss, you lose 1%, but if you're right, you get 2% in gains, and that will at least make it so that consistently, as long as you are winning, if you're winning at least one trade out of every 3 trades, you are still break even.
Yeah. So yeah, the reason I didn't want to get into it is I didn't want to lose people, really. But since you explained it so well, I decided I might as well show it here. But in TradingView specifically, you have this tool handy, the long tool, and that's precisely what I use. Everything TD said, that is exactly what I do as well. So in this specific example, I typically take 2 to 1. So in this case, I'm sort of faking it here, obviously, but assuming I would be monitoring the price here on these 2 days, and I'm seeing that it's holding up above the moving average, and I'm saying, you know what, this looks like a point of strength. It looks like the moving average is crossing over. I'm going to be taking a long position here. So I would say, assuming this is my entry at 20, then for a 2 to 1 risk ratio, like I said, I would put my stop somewhere above the moving average, and then I take the 2-factor upwards, and this would be my take profit area. So you can see in this example, I would be leaving a lot of money on the table, but I still suck about in this myself. But you need to be persistent and consistent, rather, when it comes to trading. It's better to leave money on the table, but to be consistently profitable rather than try to hit these multi-baggers, but end up getting stopped half the times. Yeah. Okay. So let me just delete this. Okay. So that was the long tool. Anyway, so let's get back to this example here. So the real point of interest here, the first one was here when the price crossed over the moving average. Remember, we're not even looking at the MACD down here, or you know what, not even OBV, just looking at the moving average to get a feeling for where the trend is going. So the moment I broke above both these moving averages, that's a point where I said this is strong momentum. And my let's say it position taking confirmation for myself is the moment the short-term moving average crossed over the long-term one. Let's see. Maximize the indicators. Sorry, that's Verde down here. You know what? Let's just open a new one here. Whatever. Let's have a look at AMC. AMC, okay. Let's maximize it. Now I don't have the moving average anymore. Sorry, Verde. I'm gonna stay with my stupid one.
Well, just double click on the chart.
Oh wow, that's amazing. And
Jesus, man.
yeah.
How do you use TradingView? You can double click on a panel to maximize it, and then you see on the top right now you have a blue thing that.
Wow.
There you go.
What a time to be alive, man. Technology. Anyway, so as you can see, the moment the moving average is crossed, we did have this big green candle. So we said we took the trade somewhere here, solely based on a naive moving average kind of approach. And then we said that we would probably leave somewhere here, but let's just follow through with the price action to see how the moving averages react to it. So we had the crossover here, and then this is the first point of interest when looking at the price action. So sometimes when we're looking at these squeeze plays, we see the price action declining, kind of like, you know, red box, it declines for some time, then bounces off into this new moon somewhere over here. But as a conservative, naive trader, this is the first point I'm looking at to exit my position. And why is that? That's because the price is flirting with the short-term moving average, and the short-term moving average stopped its climb here. It flattened out, and you can see that down here it's continuing down. But me specifically, I would probably exit in this exact moment, somewhere in this or this day, because this tells me there's been there's a stalemate, right? The trend is no longer it doesn't give me as big a confidence interval in the trend anymore. So I would be looking to exit here already. So you might have missed the moon here. Let's assume you didn't sell here. Even if you sell at this point, you're at a profit, right? Because we went in here and we're leaving here. We left a bunch of money on the table. We didn't tap into it, but we still made a profit. And this is just based on basic moving averages. Now let's continue with the example and see what is the point where things really look bad. So the price is in a free fall here over the coming days, and so we said the first point of interest is when we broke through this moving average. Remember, we sort of referred to these as resistances, and sometimes it's more psychological than anything else. But once this starts happening, this is telling me that the price descent it's a trend now. Price underneath the short-term moving averages tells me the short-term trend is down. This is the point when it's really bad. This is a place where we should have long been outside the trade. We're dropping back under the medium range moving average. And this is where shit really hits the fan. Short-term moving average crossing under a longer-term moving average. In the 250, we call this a death cross, but in a short-term point of view, this is a short-term death cross. We're officially back in downtrend over here. We've reached this layout. We have the price action. On top of it is the short-term moving average. Over it is the medium one, and the long-term one is still way up here. This is a multiple level of confirmation that this is not a trade to be taking to the long side. Now let's look at the past week or two of AMC. So we can see that over here, once again, we're kind of seeing things that look similar to what happened here. The price is crossing over the short-term moving average. Now, you can say just by looking at the graph, the price doesn't seem to be breaking under this level. 10 is a resistance point. Doesn't matter. Let's stick with the moving averages. I'm seeing the price go over the short-term moving average. This means that in terms of short-term trend only, it's no longer a confirmed downtrend. And you can see the price is flirting around with it, right? And every time you cross over it, you're expecting to see some kind of upwards momentum, even if it's only temporary. And I can tell you that I actually traded several of these crosses over the short term. I do use this quite often. I believe it was this one. Yeah, I think Verde knows about this one. I took it live with him. But the idea here is all the same. The moment we crossed under it, the price broke back over it. There is this battle, and the price is serving as support, it seems. It never breaks fully under it, just like here, where for a longer term, or for a longer period of time, we're under the moving average. Over here, it's not as decided. So what does this tell me? It means for the medium term anyway, I don't want to take a long position because I'm still way under the medium one. I certainly don't want to be taking a long position. Oh no, don't tell anyone I'm not long on AMC. But in the short term, there is something to be said about the price action. So let's maybe take a pause for questions about the moving averages before I talk about EMAs versus SMAs and the MACD a little bit. Anyone have any questions? Or am I just that amazing of a teacher?
I have one. The two moving average lines that are touching the candles, the last, say, 3 candles, are those now, is that significant resistance because they're both resistance and they're together?
You're talking about these two?
Yes.
So over here, it's just too early to tell, really. This can be thought of as a limitation of just using moving averages, is that you need the trend to be confirmed before you can use it as a support for your hypothesis, right? That means you're, by definition, leaving some money on the table when the trend is starting. So much like how you left money here in this trade because you exited early, you also missed this entire part of the trend forming. So if you're a super good trader, you could have gotten in here and left somewhere here. But if you're just using the moving average, you would have only gotten somewhere around here, around the 20 level. And you would have gotten out somewhere here on the 27. So you're leaving all of this here. So what you're seeing in the last couple of days is that, yes, we are trying to break back above the price, and only after we hold above it for a couple of days, then you can say, okay, short term is potentially bullish again. Specifically, next week, I'm really interested to see what will happen here, because somewhere, assuming it goes with the same kind of momentum, June 28th is probably where we're going to be seeing the two moving averages collide. And then either it gets hard rejected and drop into infinity, but I think it might cross above, but we'll see, you know. So just to answer your original question, it sort of is resisting the price at the moment, and we need to maintain a position above it to say that for the short term we have strength.
I just add something in real quick.
For sure.
So you've got I'm not really quite sure the values of your lower SMAs there. Your fastest SMA, which would be the yellow and the light blue.
Ignore the yellow. Ignore the red,
Okay.
orange, and yellow. The
Okay.
light blue one is 20, the medium blue is 50, and this is the 200.
Okay. Well, regardless, you have a set of SMAs down there at the bottom that are, as Scrap pointed out, they're colliding, they're merging together, and that to me is just showing you consolidation at a lower price level. You're consolidating, those lines are merging together, because moving averages, you also want to consider distance of price from the moving average and then between each other. So relative distance is always going to give you an idea of if you're in a range, if you're consolidating, or if you're in a trend. Price getting further away or closer to those moving averages will start to show those periods, especially when you're looking at them in sets and not just individually.
Yeah, definitely. That is all very true. Thank you, Occam. This is kind of something I was saying earlier, but in a way more dumbed down fashion. And that's what I said was the price was trying to decide where it's going. And that's essentially what Occam's was saying. We're trading in a range here. There is consolidation happening. But yeah, in a very naive kind of way to look at it, I'm waiting for a trend to form so I can trade it. This is the super smooth brain version of what Occam just said. Any other questions or additions or corrections? Nothing I'm saying is Bible, guys. And
You're
gals.
doing great.
Thank you, sir.
Mo Herbert is asking, what color do you use for each of the time periods?
Wait. Let me go into the chat. What card do you use for each of the time periods? Okay, so the blue ones are simple moving averages, and the darker they are, the quote-unquote slower they are, right? So the lightest is the shortest one. This is 20. The medium blue one is 50, and the least hot one, so to say, is the 200. That's assuming I understood the question correctly. What color do you
Yeah,
switch?
I think so.
Yeah.
Also, with TradingView, you can set up whatever color you want. So, for example, I used to have green for 20. I used to use then yellow for 50, orange for 100, and red for 200. And that was basically a color, like a color spectrum. That for me was saying like, hot, cold to hot type thing.
Yeah. That's kind of what I
but
have going, but I'm colorblind and stupid, so this might seem kind of convoluted to other people. Anything else there was on the floor? Let me have a quick look.